out this afternoon. Now, Sam is the co-founder and CEO of Alameda Research, a quantitative cryptocurrency trading firm. Alameda trades 150 million per day worldwide, really providing the kind of liquidity across all major regions, exchanges, coins, and OTC. Before founding Alameda, Sam was a trader on Jane Street Capital's international ETF desk. Sam graduated with a degree in physics from MIT. Wei Zhou, whom you may know, is an experienced capital market specialist, chief financial officer at Binance. Wei started his career at Goldman Sachs, and from there, Wei has had 2 successful initial public offerings, IPOs. As the CFO of Chinese online recruitment platform Zhaopin Limited and one of the country's leading advertising companies, Charm Communication, he led both firms' IPOs on the New York Stock Exchange and NASDAQ, respectively. So here they are, Wei and Sam, and this exclusive fireside chat. Take it away, guys.
Thanks, everybody. Hey, Sam.
Hey.
Welcome to Binance.
Thanks for having us.
Thanks for that very kind introduction. So I'll give a little bit of background in terms of what we're going to talk about here today. Because I think my responsibility and mission is sort of being the chief financial officer at Binance is I'm helping CZ basically to build out our fiat businesses around the world. And as sort of I've been traveling around the world, sort of looking at different markets, talking to different people, and meeting with different regulators, and meeting a lot of the financial institutions. One of the feedback that I get is basically, when is the traditional money going to come into the space? And I thought, what a better person to talk about that than someone who basically transitioned his career trading ETFs and building financial products for some of the traditional financial institutions from the algorithmic trading side of the world to basically now bring that skill set and that kind of mindset into the cryptocurrency space. So a little bit of background, a little bit more detail about Alameda Research. They have a very nice little booklet in our package. That's actually the least glitzy booklet you ever see at a cryptocurrency conference, but it has basically packed with content, right? Just like Sam himself here. So Alameda Research, they're one of the top sort of trading firms on Binance. They're one of our key partners as we build up our over-the-counter business, OTC business. And Sam and his team launched the fund about a year ago, a little bit under, and then they've basically been trading for about a year. And if you look at their performances based on their size, it's excellent. Basically average at least 4 to 5% return on a monthly basis. During the last 2 quarters, where Bitcoin is basically down over 50%, they've been annualizing at over about 100% last year. And I think one of the questions I'm going to ask is this sort of type of, I would say, return mindset, how is that different? Because when I first started going on Binance, I talked about like 1 minute, I was like, holy crap, there's all these basic trading currencies. There's no way a human mind can trade this, right? So, so the first question I'm going to ask Sam is something that's in his little booklet is, why did Bitcoin fall so much?
Yeah, so obviously there are a lot of causes to this, and to some extent the answer is I don't know, no one knows, who knows? It was, the mysterious whales everyone keeps blaming for all of their problems. But one thing which I do think was at least, a fair bit of this cause was liquidations. And so what you see happening here basically is, someone has $10 million, they use it to buy $100 million of exposure to Bitcoin, whether it's through a futures contract, margin trading, something like that, and then Bitcoin starts going down. And the problem is because they were levered, actually if Bitcoin goes down 10%, they're bankrupt. But they still have this giant position on, so if it goes down another percent, then somehow they have negative dollars. That's pretty bad. It's not clear how you get negative dollars into someone's account. And so what you have to do is basically you have to sell out their entire position before they go bankrupt. And this is pretty terrifying if their position is super big and it's really close to bankruptcy, because they just need to slam the market. They just need to send a market order for their entire size. And that can have a lot of impact. Markets start falling on that. And, well, okay, now even more people are getting liquidated. And if you get this sort of death spiral, where you kind of cross this critical ratio of how much size these liquidations are actually getting filled versus how much impact they're having, where they're just digging themselves into a deeper and deeper hole. So that's a risk that you always face when people are trading on leverage. And the 2008 financial crash, you saw what happened when banks had extremely levered junk bonds on and had to start liquidating them. So recently we've seen that happen with some futures contracts in crypto, where for a variety of reasons, a big part of which is like sort of poorly designed contracts in the first place, you see these death spirals. You see futures crashing 20%, spot crashing 10%, and it's clearly the futures that are driving a lot of this, as hundreds of millions of dollars just get sold off instantly. And if you try and trace the Bitcoin movement down from say 7,000 to 4,000, a lot of those sharp down moves actually really seem to be at least in significant part caused by these death spiral liquidations.
So I think that's a very interesting topic, right? Because these kind of falls then would trigger a mindset that something terrible is happening. Meanwhile, it's actually quite something that is quite minuscule, or something that is a faulty design in trading futures trading platform, right? So this goes back to sort of like, how can we design a better system for us to project confidence or to project reality to a certain degree, such that any mishaps won't get magnified in this because of a faulty design in futures trading platform somewhere in the world, right? So can you tell a little bit about what you do then, or what do you hope to accomplish with Alameda research in terms of solving that type of sort of liquidation problem?
Yeah.
Because I think a lot of it is information, it's liquidity,
It's all that. And I do want to just really underscore something Wei said, which is that if Bitcoin is massively overvalued, it should go down. And I'm totally in favor of that. People should be allowed to sell if they think it's super rich. But the sort of weird thing that's happening here is it's not that people think it's massively overvalued. It's that there's these weird contracts that were designed poorly, and now all of a sudden people who don't want to sell their position are being forced to because they're running out of money. And this is not like an economic, oh God, something really just happened to the, future value of the Bitcoin network that's causing this down price move. It really is this weird secondary market liquidation nonsense that's causing it. And it sure shouldn't happen. So, what can we do? I think historically what we've done, and what we originally saw our role in this as, is just providing liquidity in these contracts. So, one thing that we can do is, as this death spiral starts approaching, especially, I think we talked earlier on the, derivatives panel about, one of the obvious trades in derivatives is, well, if these futures are now at a 10% discount, why don't you just buy the futures and sell Bitcoins? And by buying the futures, you kind of, stave off this death spiral before it really gets started. And that is, a thing that we've been doing, and originally how we saw our role here. And I think it is a really important role because it at least helps to solve the problem of, what if it's just these futures contracts crashing? It's not even that much seismic, it looks like there's no liquidity here. And so, that's absolutely something we've been doing. Now, if the death spiral is strong enough, then maybe even buying at a 10% discount is even good if it's about to go to a 20% discount. Who knows? Maybe this thing's gonna be worthless soon because of some weird clawbacks, but at least that does something there. That kind of puts a little bit of backstop to these liquidations. But I think recently we've started to feel like maybe we should be playing a larger and more general role in this, because part of what's going on here is a lack of liquidity in these contracts. There just aren't enough people who are buying futures when they start falling. But part of this is the futures were pretty fucked up in the first place. But there's just really, really bad design in some of these contracts. And given that that's what's causing some of these problems in the first place, we now see part of our role here probably is to address those problems. And so we've started reaching out, to a bunch of exchanges who have, margin trading futures contracts, and talking with them about, hey, obviously, we're kind of nice about it, we're like, really appreciate you, blah, blah, but here's some things I really think you should change about your platform, and not just make it better, but specifically, this number that you have, this parameter, make it this other number instead, and here's an explanation why that'll help. But the central thing we're trying to attack there is stopping the situation in the first place where people need to get massive liquidations quickly. So having reasonable margin requirements so that liquidations can happen at a reasonable pace, thinking hard about how big of a position someone should be putting on, and thinking about how those, trying to reform these things in the first place, and then making sure the futures contracts don't have weird patches in them that can cause them to be worthless for weird reasons, which has happened before. Futures contracts settle into very different numbers than what you might think they would. So, so we've started reaching out, to existing players, and we've also started thinking about, what advice should we give all the exchanges in this space, whether or not they currently have this. I know we've had a lot of fun interacting with a lot of the folks, with Binance about it.
So who followed that? Yeah? So what I want to get to is basically, so we're in this sort of, I would say kind of a logic, right? I mean, there's a tremendous amount of interest that are interested into cryptocurrency, that are interested in looking. I think the volatility over the last few months and few quarters have actually driven more interest, right? In terms of basically capital looking for return, right? Looking for basically looking for this kind of arbitrage situation, right? And I think what the role that we're trying to play here at Binance, I mean, is basically being one of the exchanges that Alameda trades on, is sort of what do you expect from the exchanges per se, right? And what do you see sort of like at Binance that really differentiates us from some of the other exchanges? Because I think you guys trade on.
Trade on.
Right? And I think, you know, so sort of like going back to what I said earlier, is like, in order to attract more institutional liquidity into the marketplace, you need better exchanges, right? Which is something that we're trying to do, right? So I think the first part is basically, let's figure out sort of like the future part of the business, but I think that's one of the potential products, right? Where are these funds, where are these futures traded? On exchanges, right? And I think, let's talk about exchanges a little.
Yeah, absolutely. I think that's a huge part of this. Exchanges play a really, really central role in crypto. I've already talked about them a lot, but it's worth noting that, you know, in traditional finance they play a substantially smaller role, but in crypto they really are a central part of the ecosystem. And there are a lot of reasons for this, including that the actual movement of coins around is a central part of cryptocurrency in the first place. And so it makes sense that exchanges would sort of also double as, you know, wallet services and things like that are a really important institution here. And yeah, I think, you know, futures are one side of this, but there are a lot of parts of this. And, you know, obviously there's a very heavily publicized fake volume exchanges, and that's a real problem. And, you know, basically what happened was there are a lot of exchanges that realized, wow, so we could either try and started an exchange 3 years ago and build a really great product, hire a lot of great people, or we could just pay someone to self-trade a lot on our exchange. And all of a sudden our volume numbers skyrocket. Now we kind of try and gain coin market cap here. And so, you know, you briefly saw, you know, Binance number one. Then there's one with Binance like number 8 in volume, with 5 exchanges claiming to trade $6 billion a day. And of course, it's all fake volume. Like, they're not actual trades going on those, you know, those new exchanges that popped up there. So that's sort of, you know, one obvious thing where if you're an institutional player, you know, if you're Goldman Sachs and you're thinking, should we trade in crypto? Let's hear about these exchanges. If the first thing here is, yeah, some of these exchanges, 90% of their volume is self-trading that they're paying people to bump up their volume numbers, you're like, no way I'm getting involved in this space. Like, that's unbelievably illegal in normal markets. And really just underscores, you know, how far many of these players have to come before it can start to look like, you know, the institutional grade exchanges that institutional grade players would really feel comfortable trading on. And you know, one thing I will say is all the exchanges, they have their strengths, they have their weaknesses. It's, you know, obviously been pretty good working with Binance. Like, there's a reason that you don't hear a lot of horror stories about Binance in, you know, on Twitter and on whatever your favorite, you know, terrible news channel is for this, and it's because there aren't, you know, really that many. You know, I think step one is just like, don't do really bad things. And it's actually not very many exchanges who just never do really bad things. There's like a pretty short list, right? I think there's like maybe 5 or so exchanges, and there are hundreds of exchanges in crypto, but maybe 5 who I think there's nothing I've ever seen them do where I'm like, I cannot believe they did that. Like, that was unbelievably unprofessional. And, you know, to talk about some of these things, like, you know, massive amounts of fake volume is obviously one of these things. Another thing is just like refusing withdrawals. That's a thing that like some exchanges are fond of doing. They're just like, sorry, your account, you can't withdraw this week. And they give some reason that's obviously wrong. They're like, technical maintenance. You can't withdraw any of your assets. Everyone else on our exchange can, but not you. It's technical maintenance. Like, it's not technical maintenance. You know, there are a lot of possible explanations for this, but that's one of these things where, you know, if you're trading exchanges, that's our biggest nightmare, right? We're putting our assets on these exchanges. If the exchange just has fake volume, that's not good. But the worst that happens is we like put some time into it, then we're like, wait, there's nothing going on here. Like, and then we pull out. But an exchange refusing to let us get our assets back, that could be a big loss for us. So, you know, that's one sort of thing that like shockingly many exchanges do a lot. You can say like not having an API. That's the thing some exchanges have done, right? Like literally, you can point and click, that's fine, but if you want to write an automated trading system, there's no protocol for that, they haven't written one. And, you know, you can look at like things that are called US dollar but have very little to do with the actual US dollar. They're just like, that's the ticker they gave it, but you can't withdraw it to your bank account by a wire transfer. You just send it to some third-party scam whose logo is like this blinking Illuminati sign. Like, that's how you get, I'm not joking, that's how you get your money on some of these exchanges. And you're like, they're definitely gonna steal it. Like, you go third-party scam to Brazilian bank account with a 20% fee, that's how you're getting your money. So, you know, the first thing is just get rid of the really bad stuff, which is like an enormous problem.
Are you seeing that right now, sort of in the market? I mean, we're seeing, I think this is one of the effects of the market, right? Sort of, you're seeing the real stuff is floating.
Yeah.
It's still floating.
The real stuff is still floating, and the fake stuff, interestingly, the fake stuff used to also have real volume just because there's a bull market, everything had volume. There's so much volume everywhere. People didn't even have to fake their volume numbers. Now, all of a sudden, that's a bear market, and actually, way fewer exchanges have real amounts of flow. You see all the fake exchanges starting to go to greater and greater lengths to pretend to still have large volume, which is why you're seeing this like massive amount of exchanges faking their volume, because all of a sudden they no longer have volume. But they would go out of business if everyone realized this. And so they have to keep up the appearance of it. So I think weirdly, it's like more and more players are no longer important in the exchange game, but they're still sticking around. It was such a lucrative year for so many of these players in 2017 and 2018 that they have enough of a war chest to survive for a little bit longer, and they're just doing whatever marketing gimmicks they can to try and pretend that they're still legit. And it's becoming harder and harder actually to tell who's real and who's not. You know, we have to invest enormous amounts of time. CoinMarketCap is doing everything they can to get this right, but there's still so many things they haven't gotten to because now 80% of
How many exchanges are you guys plugged into?
I think we're plugged into something like 45. We're, you know, maybe trading on 30, but obviously, you know, most of our volume is going to be on the top exchanges.
So we talked about futures contract, its design, how that's sort of one of the problems that we're hoping to have a solution. Exchange. The third one I really want to focus on, I think the next panel is going to spend a lot more time on, is actually just stablecoins, right? And where this comes from is basically, for Binance right now, stablecoin has basically become a key product that we're pushing out, right? We've listed multiple number of them, and I think from sort of an investor perspective, do you see the line between fiat and stablecoin more blur now, or what do you see sort of, how you see the future of stablecoin? Now, we leave a lot more of the next panel, but just
Yeah.
comments. They published a quite an interesting piece about how they judge it, how they rate the stablecoin.
Yeah, it's becoming a lot more clear now because all of a sudden there are a few new stablecoins that are actually very easily fungible with the US dollar. And so you look at something like, you know, a USD coin, a trust token, something like that, that's say on exchange, the line between having one of these coins and having a dollar, you know, if it takes you 3 minutes to convert between them, you know, what's the difference between like a dollar on a fiat-enabled exchange and a stablecoin there if both of them you can click a button to withdraw to your bank account? So we are starting to see stablecoins that can really fully fund for the US dollar. And I think they're playing a central role and I expect them to continue to. I think they're a great product. As anyone who's tried to do banking in crypto has learned, banking in crypto sucks. It's a nightmare. Banks don't want to deal with crypto. You know, Bank of America isn't going to be, we once opened a Bank of America account, and like a month later, someone out there realized, wait, so your time, you gave a bank account to a cryptocurrency trading startup. It's got a bunch of 20-something-year-olds. They're sending millions of dollars of wire transfers across the globe to sketchy crypto exchanges every day in many different currencies. That's literally the worst client you could have, right? If you're at the compliance department of a big bank, banking crypto is a nightmare. AML, KYC. You know, they ask us, can we AML, KYC every mature? It's like, yeah, absolutely, we do have friends. They're like, well, how about the people you trade against on exchanges? We're like, well, no, it's an exchange, it's not right. So it's a total nightmare. And because of that, trying to just reduce the interface between crypto and fiat is super valuable. If every exchange had to have fully sufficient banking license that could bank every in every country, they just couldn't. No exchange can do that. And so what stablecoins let you do is have this single portal where some parties are able to convert between it and the fiat currency. So, you know, the US players can convert between the US stablecoins and US dollar at 1-to-1, and then they can do that or ship them off to exchanges, and exchanges can treat these stablecoins basically like a dollar. and they will be basically $1, because if they ever start trading at 99 cents, all the US players will buy them up and redeem them for $1. And if they trade at 1 spot at 1, they'll just create a bunch and send it over. And so it enables all the exchanges to trade things which are very close to fiat currencies, effectively just as good. You can move them around between exchanges in 10 minutes instead of a day. Wire transfer, it's great for all those purposes. Or longer. I mean, a day if your banks are fully cooperative. And you can just really limit to have this one, interface between fiat and crypto that you absolutely trust, and put all your banking energy into that single interface. So I think stablecoins are great for this space. They unlock a ton. And I'm super excited about some of the new offerings that we have here, where we are finally getting stablecoins that these really are, fungible with the dollar. A big problem with stablecoins is you could imagine that, like, the important part of a stablecoin, it's actually a pretty simple concept. Now, the execution can be tricky, but the concept is it's a token. You can send $1 and mint a token, and you can send the token to get your dollar back. That's the structure of it. But somehow, about half the companies in the space have not successfully implemented that structure. In fact, they've intentionally not implemented the you can send it back and get your dollar part, because they don't want their market cap going down. And so all of a sudden, there's this rash of stable coins, which, well, okay, if they ever trade above $1, yeah, you can create as many as you want. If they start trading below $1 and try and redeem it, well, we'll see. We'll see about that. And that's also terrifying, right? You imagine, like, if you're an exchange, you're saying, yeah, we've basically got a Bitcoin to USD-like market. It's our Bitcoin to US stablecoin market. What happens if that stablecoin goes to zero? Like, it's a nightmare, right? All of a sudden, Bitcoin's trading at infinity on the exchange, I guess. All these users who thought they had dollars basically on the exchange have nothing. They're bankrupt. Like, it's really, really bad. This is basically an existential. If you talk about, like, other than if Bitcoin goes to zero, that's obviously existential for crypto. What else could be existential? I think it's a really short list of things. I think it's basically if Bitcoin goes to zero, Binance steals all their users' money or blows out or something like that. Like, there are only a couple exchanges that could actually take down crypto if they went out. Or a major stablecoin goes to zero. I think that's actually basically existential. It's like so much of the ecosystem. And like, here's a question, like, what's the ratio of trading a Bitcoin to stablecoin versus Bitcoin to USD? The answer is like 10 to 1. It's massively more volume in stablecoins than US dollar because it's so much easier to interface with. But that also means that 90% of crypto trading goes under if stablecoins go under. And so, I'm super excited to see this space develop, but I think it's really, really important that the stablecoins get this right, and that exchanges are aware of which stablecoins are getting this right, and which stablecoins are really going to be there for you when you need them, and which ones, sure, maybe it's like more stable than a Bitcoin, but it's not actually really $1 when you need it.
So just one comment on stablecoins is, so we launched Binance Uganda, and one of the use cases that we've seen is for Bitcoin in Africa, sub-Saharan Africa, is the need for US dollars because of the instability in the currencies in pretty much most of the countries there. So I think stablecoin could have a really potential sort of real life use case there in terms of storage of wealth, protection of value in that case. And then the fourth comment I want to get to is in terms of secondary markets is OTC. Right? I think some of you know, some of you don't know, Binance started our own OTC desk. I think last week, Bitrix mentioned they're going to support 200 plus, coins. Coinbase have gone out and said, so basically exchanges are starting OTC practices. Whereas sort of, I think there's a lot of sort of traditional players, the names that opened up our conference with CZ, at Cumberland, some of the bigger OTC shops. Sort of, where do you see Alameda play sort of in this role? Because I think we actually are trying to work on some of the stuff.
Yeah. So first of all, just want to say I've had a lot of pleasure interacting with the OTC efforts for Binance. I think we are pretty massively looking to scale up this area for operations. So 2-3 months ago, we basically did nothing OTC. We were almost entirely exchange-driven trading. And over the last few months, we've ramped that up quite a bit. We're now trading 10-15 million a day OTC. And I think that we play a somewhat specific role in the OTC space, which is not exactly the same as all the other players, which is that we're not a retail-focused company. We don't have mass marketing. We don't have an army of people ready to AML KYC 30 new users a day.
And I think I want to go a little bit, because I think like when I first started thinking about OTC, it's sort of like, I thought of basically somewhere where I could buy a million, not for me, but sort of $1 million, 2 million Bitcoins, or 100,000 Bitcoins, all these orders. Some son of a grandson of a Greek shipping tycoon wants to buy 1,000 Bitcoins. What does he do? Can you give me 5% float market, right? I think that's sort of the historical perception of the quote-unquote OTC market. But I think what we're seeing is sort of an evolution of the OTC market of basically providing off-exchange liquidity very specifically, right? That's something that we're trying to build with, Alameda and some of the other players, is basically how do we help the project companies or the investors into these project companies to provide off-exchange liquidity for their coins.
Yeah, I think that's right.
That's sort of the clarification.
I think it's absolutely right. The way to think of it is something like, if the trade you want, you can just lift the top offer on Binance and you're done, then great, do that. But if it's more complicated than that, you can often get better pricing if you try and do some OTC trade, because you can basically offload the execution of that to someone whose 24-hour-a-day job is figuring out how to do exactly that. Buying more Bitcoins than you can buy immediately on Binance. And you can do your, go back to your job and not spend all of your time staring at this market,
Click.
Yep. And so, yeah, and I think that like the role that we see ourselves playing is not a super, not a place that wants to have, 3 million customers, is what we have is liquidity. We trade, I guess we're now trading maybe 250 million a day on exchange on average. And what that means is that like we have a really deep pool of, liquidity to source from. We have really low execution costs just because we already have a giant exchange book. And we can net this off against, our trading on 30 different exchanges, 1,000 different markets, 30 different derivatives products. And we have automated systems which are built to do this in real time. And so the role that we've started to play here is almost as like an OTC desk for other OTC desks, where, and that's why I think we're, super excited to work with a place like, the Binance OTC desk, because, the role that we're really doing here is we can offer really aggressive pricing. And we can offer instant 24/7 access to aggressive pricing, easy interface, things like that. We don't know all the customers who want to do this. And so, the role that we have been playing is we've been, dealing a lot with the other OTC desks where, their specialty is, getting the OTC flow, understanding that business, and our specialty is, whatever they have left net at the end, figuring out how to actually work out of those deltas on exchange. And so that's, that's sort of the niche that we have found ourselves most playing. And obviously we're going to continue to see how this evolves. But, at least for now, that's what we're most excited to keep scaling up, is seeing ourselves as sort of more like an, institutional grade OTC coverage for players, and, as opposed to, knocking on doors to try and,
Sure.
Do the things that you need to do if you want to build, for instance, a really successful exchange.
And the last question, tell me about effective altruism. I think that's something you see you wear that shirt quite a bit, and it's mentioned in a little booklet.
Yeah.
Because that's his, it's altruism is a big part of. How this book gets started about the charity foundation, and I think it's really cool that like sort of very young organizations from day one start thinking about altruism and charity.
Yeah, so I think that I've been pretty, cared a lot about for a while is, essentially the question of how can I do the most good in my life? And, thinking about that from a quantitative angle of, well, obviously it's impossible to exactly measure this, but that doesn't mean we can't estimate it. In sort of our trading as well, we can't exactly predict down to the penny how much we're going to make on a trade, but that doesn't mean we can't do anything. We come up with the best guess we can. And so, sort of, where effective altruism started out as is, if you're going to donate $1, which charity can kind of do the most good for that dollar? And the first question is, if you're just trying to save lives, how can you save the most current lives per dollar that you donate? And look at things like, anti-malaria, bed nets in sub-Saharan Africa, cystomyosis, which is a nasty disease, deworming pills, basically looking at, pretty poor countries that have very, very low medical coverage, and what are the diseases that are killing a bunch of people there that we've totally cured in first world countries because they're not that expensive to cure, and how can we build a system there that can work on those. And these efforts have successfully drastically reduced malaria rates around the world. So it's sort of where it started out, and it's grown since then into just more generally, if you're trying to think about, well, what things could really impact the long-run view of the world. Maybe you think, climate change, that could destroy the world. And it's a really important thing, but then you start to think, well, it's also really popular. A bunch of dollars are going into it. Are there things sort of like that are still in their infancy stage where you can radically shape that field or cause it to exist in the first place? That will be able to do a ton of good. So that's sort of what EA is in general. And I've spent a bunch of time in my life trying to figure out what's the best thing I can do. I don't know what it is, but my current best guess is to find ways to donate as much as I can. So I've at Jade Street before this, and now at Alameda, I really love the work. I love the people I work with. I've been really fortunate that this job happens to be a job that I really like. But in the end, the thing I care most about is what I can do with whatever money I make from it and where I can give it. So.
Great. Why don't you join me in applause and thank Sam for his time and some very wonderful insights.
Thanks, guys. All right. So we've gone from cryptocurrency as a hedge asset to this emergence of something called stable coins. And there really are two camps on stable coins, right? Is it the ultimate crypto hedging solution? Is this where mass adopters feel more comfortable in using crypto and the fiat worlds and having them merge and combine together? Will there be a winner take all or multiple winners? These are really critical questions that are evolving right now when we talk about stable coins. Well, Anthony Pompliano, also known as Pomp, is going to lead this conversation for us next. Help us understand the different pegs and models of stable coins, the current landscape of regulations, and a whole lot more. Please help me welcome Pomp to the stage and his panelists.
You guys hear me? So they told us this isn't recorded and we can say wild stuff, so get ready.
You're very organized.
All right, we have 30 minutes. We're just going to cut right to the chase. Why the hell are all the stable coins backed by different things? And which one's the right way to back these?
Well,
back that off to a real high.
Yeah, you need backed by different companies. You mean
No,
like
so it's backed by dollars, right? Different global currencies, commodities, baskets, etc. Why are people backing them by different things, and what's the correct way to back them?
Right. Well, I think what we've seen so far is the only viable model that's emerged so far is asset-backed stablecoins. So these are stablecoins backed by real-world assets. We have seen with DAI that a crypto collateralized stablecoin can work as well. So I don't want to take away from their success. But the reason why you've seen a lot of asset-backed coins emerge is because the model simply works. So whether you're backing it with gold or US dollars or Korean won, it's a simple model people understand, but it allows people to transact on the blockchain in traditional currencies and assets.
I also think, if you think of it from a more fundamental standpoint, right, what we're doing with stable tokens or using blockchain for these types of things is we're creating new derivatives. We have new financial instruments that we've never been able to use before. And people are running around trying to figure out how to use them as best as possible, right? So if you can look at it through that framework of what can you do with blockchain tech to create a new derivative in financial markets, that's where I think we're seeing a lot of this new stuff coming. And no one's figured it out yet.
But will people ultimately use a derivative, or will some sort of crypto native store value native exchange